Hey guys, Kalen here. We've been getting some questions just about how to actually execute orders and stuff like that properly, just like what the different types of orders mean. So we're just going to do a really quick video, just go over the basic order types, how to use them, what they're used for, etc. So we'll get right into it. I'll try not to take too long because it's not the most exciting topic in the world. I got NAKD open here right now just because it's trading after hours. You can see it's one of the big crazy ones we're looking at right now. It's what did it open at today? I don't know, 30 some odd cents, and now it's at, $2, $3 after hours. Um, so basically up here, this is Interactive Brokers I'm using. I don't have level 2 or the time and sales or anything open. I just want to keep it super simple for you guys. Every broker is going to have basically the same sort of setup. They'll just, it might look a little different. Some have a few more options than others, but it'll basically be the same thing. So on here, this is your order quantity. You can adjust these to whatever presets you want. I have them all set just in hundreds, and the base is 100 as well. But you can go in here, type in 125 or whatever you want to do. If you want to set a limit order, that's kind of the default here. That's usually what I would recommend for most cases in buying. Basically, what that means is you're setting an order, a buy or a sell, for a specific price. So this is after hours right now, but basically, if I wanted to go say buy this stock at $2, I would say buy limit, type in my limit price of $2, and then hit submit. And then you can see on the chart here, it just pops up. So I have a buy order sitting there at $2, and it shows up in my live feed here as well. So NAKD, buy, type of order is a limit, detail limit is at $2, quantity is 125 shares. And then if it ends up coming down there, it'll show me how many it's filled as well, because the bigger orders you get, sometimes you'll only get a partial fill, and that'll show up in here. And then it'll tell you your fill price as well, which if you have a limit order should be exactly $2. So that's basically the basic limit order. The next
order canceled.
The next one is a market order. I wouldn't usually recommend these. These are usually used for like cutting your losses, essentially, because if you're doing a market order, chances are you're probably panicking and just trying to buy really quick. Basically, what that means is it's just going to execute at whatever the market fill price is at the time. So right now, you can see this one. We have quite a bit of volume after hours. Like we're still trading, I don't know, at least a couple 100,000 shares a minute right now after hours. So if you look up here, these two prices, this is the bid price and the ask. So they're only a penny apart right now. So, if you were there for a second, it was, see right now it's splitting at, 3 cents, 4 cents apart. So that'll usually be 1 cent apart if it's something that's trading with a lot of volume. But if you get into stocks that are trading with less volume, it could spread out quite a bit. So, let's say you wanted to buy the stock, like if it was this stock, and let's say the spread right now, which is the difference between these two numbers, is 260 and 270. So if you wanted to buy this stock and you just hit buy 100 shares at market, it's not going to execute right now because I have it after hours. But if you had buy at market, you'd submit that, and then it comes through here as a market order. And basically, a market order is just going to execute you at whatever the closest available price is, which in this case would be the high price because that's the sell price. So if this was a 260, 270, and you just hit a market order, it would fill you at 270. So that's obviously not ideal because you're not getting the best entry price.
Order canceled.
I'm just going to turn the volume down on that. I'm not sure if you guys can hear that or not. So the next thing you want to look at is this right here, which is basically when the order is going to be good until. So some of these have longer, like some of these have like a whole bunch of different things you can do, but the most basic is day and good to close. Some of them have good till date or, a couple other things. But basically, I mean, for the most part, you're going to be doing day. And that essentially means that once, if you submit an order with a day time frame on it, then once the market closes, that order is just going to automatically cancel itself. So you don't have to worry about, it randomly executing the next day or something like that. If you have good till close, this is usually something you want to put on for like swing trades or like long-term investing. And, you can do the same thing, put a limit order in for, $2 again, say, for buy, submit that order. Oh, sorry, that came through as a day. Good to close. See, that's a good point. Actually, it tells you that it's going to be canceled at a specific time, right? If you just put that through as a day. But if you do good till close at $2, submit that, will automatically, okay, what's this? Canceled at 6:30. Okay, so this is telling me that this order is going to be canceled on, what is that? 2021 06:30. So that looks like it's, what is that, June 30th? I'm not sure why. That might just be something in the broker that it only lets it sit for a certain amount of months. But basically, like a good till close order, it'll just sit there until it gets executed. So if you're doing swing trading, if you bought something and you're not paying attention to it or whatever, and you want to sell it a few weeks down the road at X amount of price, then you just put in you bought your shares, you put in your sell order at whatever the price is, and then that'll just execute, and the order will sit there forever until it actually executes. The next type of order is a stop. And these are basically what you're going to want to use for your risk. So anytime you're in something, you always want to have a stop loss in place. So like right now, for example, if we're looking at this chart, this kind of 220 area, I would probably set that as like a rough stop loss, because you can see it's kind of bounced off here twice now after hours. So if it drops below this, I'd probably want to get out. So basically all you do is, let's say you're in this 100 shares right now. So I have 100 shares, I'm in at $2.50. Then what I do is I'd put a sell of a stop here at 220. So if I submit that, basically what that does is if I'm in this stock up here, what's going to happen is as soon as it hits 220, that's just going to execute a market order. Now, like market orders, obviously they have the spread on them, so you're not necessarily going to get the absolute best fill, but depending how fast it rips through that line, market orders are always the best, because it's just going to get you out. It's going to get you out quick, and there's no questions asked. So that's the way you use a stop loss. You can do it on the flip side as well. So let's say, I'm short in here right now, and, maybe I want to risk off of this top right here, this little $3 bump. Then if I was short, all you do is the exact same thing on the opposite. So you say buy, stop at, say, 302, just a couple cents above that top there. Submit that, and then it's the exact same thing. So if I was short here in the 250s and it went up, as soon as it hit 302, it would just execute a market cover order and close me out of my position immediately. What's the next thing we can do here? Oh, if you wanted to put profit takers and stuff on, some of the plays that I like to do are dip buys and shorts on spikes, like parabolic spikes. So for example, I don't know if this one really did it in the morning at all. Yeah, it kind of did. So like around here, for example, like, this might be something that I try and short into as one of these spikes here. So what you could do, because these moves are pretty quick, like these are off obviously 1 minute candles. So, we had 3 minutes up, and then in 1 minute we had this big smackdown right here. So let's say, what's our top 95-ish, for example. So let's just say, I want to sell 1,000 shares at 95 cents. And then what you can do is, I'm not sure how it shows up on different brokers, but they all should have this feature on here. In Interactive Brokers, you just click advanced. And then all you do is you go right here, attach a stop loss profit taker bracket. So if you go in here, then you can go profit taker, let's say 90 cents. I want to take profits, and stop loss, I want to go, 97 cents or whatever. So I'm getting roughly a 2-to-1. And then usually what I'll do on these is I hit save, and then it'll pop up in here, so I can just re-review it quickly. And then you can see it shows up on the charts here as well. It's kind of cluttered, so you can't read it that well. But basically, this is just saying there's a sell order here at 95 cents, which is my short order. And then there's a stop limit cover, which is this one right here, which is basically my stop loss. So that's a market order if that gets executed. And then down here is my, this is my cover price for my profits. So if I just hit submit on the main order up here, because these are all, you can see these are all kind of tangents off that main order. You just hit submit on that top order, and then that'll just sit there. And then what that does basically is like sometimes you might be trying to do something like this, and same on the flip side, if you're trying to dip buy, it might kind of rip up into this so quick that it'll just, I'll short and cover almost immediately and take my loss, which is fine because that was my risk anyways. But there's also times where, it might hit this and tank so quick and then bounce up again that you don't have time to type all that in. So these are these are really, really handy in these quick moves, like especially first thing in the morning. Like a lot of the patterns that I play are, you know, within the first couple minutes of the day, I'm looking for a spike and, you know, a quick smash down, and I'll lay out a whole bunch of these. Like I'll have, you know, if it was something like this, let's just say this was 930 right here, you know, 931, 932, and this was kind of my overhead resistance. I might have an order like this. I might also have, you know, another 1,000 shares at say, you know, 0.92, and then same thing, we'll go in here, you know, profit taker. Maybe that one I'll put, you know, the profit taker at say 0.89, 0.89, and then my stop loss, same thing on the same stop loss, 0.97, and that'll just sit right on top of the other one. So you'll have the same thing. Submit that, and now, you know, you can see I got multiple orders in there. So basically what this is really helpful for is those quick moves. You know, the stock can kind of flutter around this area up and down really quick, and it might just be, you know, hitting you in and covering you and hitting you in and covering you like within a single minute candle bar. So you're just making that quick profit in seconds, and you have a stop loss in place as well, so you're protected as well if it kind of just rips up through that. So these are really, really helpful on fast moves, and you know, you can even do them on longer term moves as well. Like, I mean, if I was trying to dip buy this or something, for example, you know, there's this base here at, what is that, 71 cents, and then this bar here, it came right down to 71 cents again. So if I was trying to dip buy this, you know, I might do the same thing, only the opposite, you know, buy 1,000 shares. Maybe I just want to do it just above that. So I'll go 0.715, for example, and then advanced, I'll do my stop loss, say 0.70, just give it a, you know, a penny below, and then profit taker, you know, 0.73. So, you know, 3-to-1 risk reward. Save it again, just check, make sure everything's good. And then you can see all the lines in here, submit that order, and then that'll just sit there. And if it gets executed, it gets executed, right? And the nice thing about those as well, actually, is if I go, I'll spread them out a bit more so you can see them a little bit better here. If I go, say, buy at, you know, 70 cents, I'll go profit taker at 95, stop loss at, you know, 0.6, just so we can see it a little bit better. So this is a little bit easier to see. So, you know, if this is a dip buy, here's my buy line right here. Down here is sell stop. This is my stop limit, my market order if that hits. And then up here I have my sell limit. But what you can do too is, like, if you want to take one of these off, so, you know, let's say the thing is spiking way faster than you want it to, you know, you can just cancel one of those orders, and this, you know, this main buy order will still stay here. And then what you can do as well is, if you have a buy order or something already out there, then you can just add in your own stop loss or profit takers as well. So if you don't want to cover it all in one shot, you know, you have 1,000 shares. Let's say you want to go, you know, sell. We'll put our stop loss in of our position, stop loss of, you know, 60 cents. Submit that. Yeah, that's fine. So there's our stop loss for 60 cents. So that's our risk level right there. And then, you know, I can go, like, this is for a dip buy, so I can go sell, say, 500 shares at, I don't know, 80 cents. 80 cents. Submit that. Oh, this is telling me that there's nothing available for shorting. And then I can go sell, you know, the other 500 at, say, 95 cents. 95. Submit. Yeah. There. So basically, I have 1,000 share order buy right here at 70 cents. I have my 1,000 share stop loss at 60 cents, and then I'm selling 500 shares at 80 and 500 shares at 95. What you have to watch for if you do it this way, though, is if one of these gets executed, like if this 80 cents gets executed, since these are no longer attached to each other, you have to adjust your stop loss after. So this will get executed, and then your position size is only 500 shares, but your stop loss down here will still be 1,000. So you're gonna have to, all you have to do is go up here, just click on this, which is your stop loss, and you just change that to 500 once that order gets executed. Update it, and then you're good to go. Because if you just leave that and it's 1,000 shares, and now, like, let's say it comes up here, you know, you make your profit and then it tanks on you, then what's going to happen is it's going to hit here and it's going to execute a sell order for 1,000 shares. So you're going to have, you know, covered your last 500, and then it's going to start you short another 500, which you probably don't want. So just keep an eye on that stuff if you're doing these as separate orders. And like you can see, I mean, you can have these show up on the chart or not. I always like to have them on the chart because, you know, if you have a whole bunch of them open at the same time, you can just look at them and cancel them on the chart instead of dealing with all this stuff in here. What else? I think that's pretty much the basics of it. I don't want to go into, you know, there's like, as you can, there's a million things in here, and I would say probably the only ones you're really ever going to use is limit, market, and stop. There's trail limits you can put in as well, which basically you set like a price or like a percentage behind where your entry is. So, you know, you could set a trail limit for, I don't know, 10 cents or something, like on a stock like this. If we go over here where it's a little bit higher, you know, I could buy in here at 276 and then just set a trailing limit. So wherever it goes up to, if it goes up to 3 and then it drops to 290, it'll execute me out. Or if it goes up to 303 and drops to 293, then it'll sell me. I've never used those. I just don't really, they seem kind of weird to me. Like if the pattern's not breaking trend or anything like that, then a trailing loss is kind of useless in my opinion. They could be good, I guess, if you're, you know, if you're just doing like a swing trade, and or if you're doing something, you know, long term and you're not really paying attention, or midday or whatever, and you just kind of want to leave a little bit of a buffer there. But I mean, if you have it too tight, then any little pullback is just going to knock you out. It just kind of seems like it's not really the best idea in my opinion. Yeah, I think that's pretty much it for the basic orders. So, you know, essentially like what you want to do is, you know, use your limit prices to buy. Those are always the safest, especially for beginners. I would always recommend using a limit and at least a stop loss. You don't necessarily have to put your profit taker in there. But, you know, a limit order, you know, a buy order of say 264, and then attach a stop loss. You can just put a stop loss on there at, you know, 250, whatever, save it, and then submit it. There you have it. So, you know, you got your buy order and your stop loss in, and then once you're in, then you can, you know, size out in chunks, right? So now you have everything's basically in there, and then you can take off, you know, a third, whatever, all the way up. Oh, the other thing too is these ones here. So if you do like trading pre-market and after hours is not something I would recommend unless there's a ton of volume. Like, I mean, NAKD right now, you can see like we have, you know, like 2.5 million shares trading every minute here after hours, which is insane. Like usually if you're getting this kind of volume during the day, it drops off basically to nothing after hours. Same with pre-market, and the spreads up here are usually a little bit worse. Like they're usually not penny to penny. There's generally a couple cents in between. Rule of thumb that's, you know, really safe is whatever you would usually play size-wise during the day, I would say cut it down to at least like 30% after hours. I don't believe most brokers won't let you execute a market order after hours either. So if the thing does start tanking on you, you have to try and get ahead of it with a limit order, which can be really tricky. So just be aware of that you can't, you know, you can't just stop loss out on a lot of brokers either after hours. So you got to be careful about that. But yeah, I mean, if you're just beginning out, I would just recommend playing it during the day, you know, set your stop losses, just keep an eye on your orders. It's always nice to just save them and then take a look at them here, make sure everything's laid out the way you want it to, and then submit them. Market orders, I wouldn't use those for buying or shorting at any point, just because, you know, especially if the stock's moving really fast, you know, you could see a big wick up and then hit a market order to short. And by the time you hit the short market order, it could have cranked right back down. And then you've shorted way down here, and then it pops back up 2 seconds later. Now your average is horrible. So I wouldn't recommend that. But yeah, I think that's pretty much covers it. I want to keep this relatively quick just to give you guys the basics. Maybe we'll do another one to go in a little bit more detail on some of the other stuff later, but I think this should be a good help to get you guys rolling. So yeah, make sure you comment below, let us know anything else that you guys want to see, and like and subscribe. Thanks for watching.